Hi, my name is Roy Rumbo. I'm an accounting professor with the University of North Texas, and I'm going to be talking today about the accounting for investments by a company in another company, both debt and equity securities. And I just want to give credit to McGraw-Hill. I use their Spiceland Nelson Thomas textbook, and this lecture is specifically recorded for my intermediate accounting 2 students. And with that, I'm going to get started today. I'm going to work problems for this area. Not a lot of problems. It's going to be another one. This one's going to be kind of short and sweet on this, but we'll go through it. So again, I like to use polling questions for my class. And for this chapter for my class, I am trying to get to, do they understand some of the concepts without worrying too much about all the journal entries. Although there will be some journal entries I'll hold them accountable for. So here, the company has debt securities, which is classified as held to maturity. How will these debt securities be recorded on the balance sheet each reporting period? Maybe I'll let you read those, come up with your own answer, then I'll tell you the answer, okay? Held to maturity securities are not reported at fair value on the balance sheet, and changes to fair value are not reported in net income on the income statement. They are just reported at their amortized costs. What does that mean? Amortized cost is the same amortization schedule where we're going to record interest expense and we're going to reduce either the bond discount or bond premium down to 0. And we recorded that, and we totally ignore because the fair value of those debt securities will be different. Again, this is only for debt securities, these classifications. How about trading securities? Let you look at these, come up with your own answer for this. Well, if we're in the business of trading securities every day, like a bank, this is our business. This is like our inventory, right? We're buying and selling securities, trying to make money off that. We're not in there trying to hold it and earn interest. We are there about selling that stuff. And so we're going to record those on the balance sheet, trading security recorded on the balance sheet at their fair value. And those changes in fair value, they're going to affect the net income. And so gain or loss of the securities, whether we sell it or not, is going to be reflected in net income. By the way, for trading securities, they would naturally be in current assets, right? And they would be classified in the cash flow statement as operating cash flows, because that's part of our operations if we're trading securities. And then finally, available for sale securities, how would these be reported on the income statement and the balance sheet? Well, I hope you said B, at their fair value, because we will now reflect those securities fair value on the balance sheet, but not, because they're not trading every day, it's not our business, they will not affect net income. And so they'll go in there in our little bucket in equity called accumulated other comprehensive income. Okay, here I'm going to do some journal entries. So you might want to pause this and try to work this on your own, and then come back and restart the video and see me work it. Okay, let's do it. And I would hold my students accountable for all these journal entries. So 1/1/17, Lennox. This is the true. I don't know how much the amounts are not right, but we did on 25%, 24.5% of Alliance Corporation. And so we're going to debit in investment in Alliance for 25 million. And obviously credit cash. No. All right. For the full year of 27, Alliance recorded net income of 20 million and paid 5 million to dividends. Okay, well, we get to record our percent of that net income, if you remember correctly. So they had net income of 20 million. We, through our significant influence, helped do that. So we're going to take credit for 25% of that. So 25% of 20 million is 5 million. So we're going to debit our investment and increase our investment in Alliance for 5 million. And we're going to credit investment income, 5 million. And then finally, Alliance paid $5 million in dividends to Linux. If you get a question in an exam or whatever, you want to read this really carefully because it paid 5 million in dividends to Linux. So Linux received 5 million. They could have said they paid 20 million in dividends. And then, oh, we get 25% of those, which would have been 5 million. So read the question carefully. You could get tricked on that. Just a little thing to highlight. So we're going to, Linux now is going to debit cash for 5 million, and they're going to credit their investment Alliance, 5 million. So if we look at that investment in Alliance account, T accounts, we're going to start with that 25 million, and then we're going to take it down. We're going to increase it for the investment income, and we're going to reduce it and we end up back at 20 million. So this is considered kind of a return of our investment, not dividend income. However, keep in mind, if we did not have significant influence on less than 20%, this entry would not have happened, and this dividend would have been income. Again, less than 20% is different than if we have significant influence. And then if we own more than 51%, we are considered an owner. I'm not going to work these. All right. Well, you think about this one, then I'll try to answer it. Okay, so we have equity securities with no significant influence. Therefore, fair value is reflected in the balance sheet, and the changes in the fair value go to net income, not other comprehensive income. You're thinking, if you answered that one, you were thinking about available for sale debt securities. The equity is different, so to keep this in mind. So the at fair value with changes recorded in net income. Answer is A. Amortized cost, that's really only related to held to maturity debt securities. I had to pause myself there. Mainly this chapter, memorize these things. You're going to have to. Okay, now we have significant influence. The LSA Burger, one of my favorite restaurants up in Denton, Texas. How will these be recorded? Equity securities. All right, I hope you answered C, because we're going to ignore the fair value for equity method securities where we have significant influence, but between 20 and 50%. And we're going to record, we'll start with the original purchase price plus our percent of their ownership, just like that T account I did a few minutes ago here, minus for dividends. And that's what our investment account is. And so the fair value may be different than 20 million. Again, for this one, we ignore it. So we have three types of, in this chapter, three types of debt securities, held to maturity, trading securities available for sale. And we have three types, and you can go back and look at the accounting for all this. And we have three types of equity securities where we hold less than 20%, between 20 and 50%. That's a significant influence equity method. And over 50%, we have total control. Shareholders vote, and we own 51% of the company and the votes. Therefore, we consolidate. Those financial statements are our financial statements. I think that's the last one. Oh, you could try this one here. Give you just a little time to work it. I'm going to do this from a T account. So hopefully you've got your work done. And so we bought 25% of the common stock of Beth Marie's. And so we're going to debit our investment, credit cash, for 10 million. And then Beth Marie's made 4 million of net income. And we have significant influence because we're at 25% ownership. So we're going to record 25% of that as ours. Debit investment, credit investment income for this. And then let's see, we got, they paid 2 million in dividends. Okay. Is that 2 million in dividends to LSA Burger? No, they paid in total 2 million. We got 25% of those. That would be $500,000. You know, and so we're going to debit cash for $500,000 and credit investment in Beth Marie's. I've got 11 minus the 0.5. At the end, my value is 10.5. Answer is B. Now, if you thought it was fair value, you said there's 13 million. I think that's the answer. Oh, wow, it's indeed. It must be the right answer because they have it there for me. You know, the bad pass in your logic, they're always there. They're waiting for you in accounting multiple choice questions. I think this is the last one. Yes, that's already moving into share-based compensation. So with that, again, this is a short and sweet lecture. Hopefully it's helpful to you. Again, accounting for investments, and I wish you the best of luck. Thank you.